Picture a scenario where each sip of your morning coffee and every gas station visit is impacted by a single force, Forex. Interested? You should be. In this video, we will explore the essentials of Forex trading, providing you with insights to expertly navigate this dynamic market. So, what exactly is Forex? Consider Forex the core of global finance, a massive marketplace bustling with currency exchanges from around the globe. Unlike traditional markets that deal with physical goods, Forex specializes in currency trading. Welcome to the foreign exchange market, the largest financial hub worldwide, featuring an impressive daily trading volume exceeding $6 trillion. The excitement is constant. Forex operates 24 hours a day, from Sunday evening through Friday evening, Eastern Time, enabling you to trade at your convenience. This round-the-clock activity is supported by a global network of banks and financial institutions, ensuring the market remains active across various time zones and facilitating a fluid trading experience. A market without borders. Wondering where this powerful market exists? It's located everywhere and nowhere at once. Forex operates as a decentralized entity without a singular regulatory body. It's a vast network of banks, brokers, dealers, and governments, all seamlessly trading currencies across borders. This decentralized structure means no single organization can dominate the market, providing a level playing field for global traders. It also grants increased accessibility, allowing you to start trading from nearly anywhere with an internet connection, making Forex appealing to aspiring traders worldwide. Key concepts to get you started. Let's clarify some essential Forex terminology. Each currency has a three-letter ISO code. For example, USD represents the US dollar, while AUD signifies the Australian dollar. NZD, commonly referred to as the Kiwi, represents the New Zealand dollar, EUR denotes the euro, CAD stands for the Canadian dollar, GBP indicates the British pound, JPY is the yen, and CHF represents the Swiss franc. Familiarity with these codes is your initial step into the Forex trading world, forming the fundamental basis for understanding currency pairs and market dynamics. The dance of currency pairs. Currencies are always traded in pairs, similar to a dance where one currency leads and the other follows. For instance, consider the pound-dollar pair. If quoted at 1.12655, it signifies that 1 pound equals 1.12655 US dollars. The first currency is your base, while the second is the quote currency. This quote indicates how much of the quote currency you require to acquire one unit of the base currency. Understanding currency pairs is essential as it emphasizes the relative value of different currencies, enabling traders to forecast currency strength and market trends. When you go long on a pair like the pound-dollar, you're betting on the pound appreciating against the dollar. Conversely, if you go short, you anticipate the pound depreciating while the dollar gains strength. Major currency pairs, particularly those involving the US dollar, provide a reliable option for beginners due to their liquidity and tighter bid-ask spreads, making them less volatile and easier to manage. Liquidity ensures you can enter and exit trades with minimal price distortion, a crucial aspect for executing successful trades. Understanding pips and lot sizes. Price movements in Forex are measured in pips, representing the smallest value change. For example, if the Aussie dollar shifts from 0.6751 to 0.6752, it has gained 1 pip. Most currencies are quoted to 4 decimal places, except for the yen, which uses 2. This precision allows for meticulous tracking of market movements, vital for informed trading decisions. Pips serve as the standard measure for communicating price changes, making their understanding essential for calculating profits and losses. Lot sizes dictate the scale of your trade. A standard lot comprises 100,000 units, while mini, micro, and nano lots represent progressively smaller amounts. Selecting the appropriate lot size depends on your risk tolerance and account size, giving you control over your trading exposure. Smaller lot sizes enable beginners to launch trades with lower risk, while seasoned traders may prefer larger lots for potentially greater returns. Bid, ask, and spread, the basics. In every Forex transaction, a bid, buy, price and an ask, sell, price exist, with the spread being the difference between them. This spread represents the cost of entering a trade, varying based on market conditions and broker policies. Grasping spreads is vital, as they affect your potential profitability. A narrower spread indicates lower transaction costs and better trading conditions, while wider spreads can increase trading costs, especially in volatile markets. The power and peril of leverage. Leverage in Forex grants you the ability to control larger positions with less capital, acting as a financial amplifier. Imagine possessing the capability to trade tens or even hundreds of thousands of currency units with only a fraction of that amount in your account. While leverage offers the possibility of greater profits, it simultaneously heightens the risk of losses. Typically expressed in ratios like 150 or 1 to 100, leverage illustrates the extent to which your capital may be multiplied. This signifies that with 1 to 100 leverage, you could manage $100,000 worth of currency with only $1,000 in your account. However, caution is essential, as leverage can amplify both potential profits and losses. Practicing prudent leverage management is crucial, including establishing appropriate stop-loss levels to safeguard your capital against unforeseen market shifts. Liquidity, a trader's best friend. Imagine a market so expansive that trades create ripples as if pebbles were tossed into an ocean. That's Forex. Its vast liquidity allows traders to enter and exit positions easily, avoiding major price disruptions. This liquidity ensures you can execute trades promptly at your desired price, which is critical in a fast-paced market. High liquidity also makes the Forex market less vulnerable to manipulation, fostering a fairer and more transparent trading environment. This aspect is especially beneficial during significant economic events, where liquidity can help mitigate the impact of sudden price swings, enabling traders to take advantage of rapid market movements. Mastering market analysis, technical versus fundamental. To decipher the Forex market, traders typically utilize two primary analytical methods, technical and fundamental. Technical analysis entails examining historical price charts and patterns to forecast future movements. Traders employ various tools, such as moving averages, trend lines, and indicators like the Relative Strength Index, RSI, to identify potential entry and exit points. The rationale underpinning technical analysis is that historical price trends often repeat, offering insights into future behavior. Conversely, fundamental analysis delves into the broader economic and geopolitical factors influencing currency values. It involves scrutinizing economic indicators, like GDP growth, employment rates, and inflation, as well as keeping tabs on central bank policies and political shifts. Fundamental traders leverage this information to project market trends and make informed trading choices. Successful Forex trading often involves integrating both techniques, using technical analysis for timing trades and fundamental analysis for broader market comprehension. Risk management, protecting your capital. Effective risk management serves as the foundation of successful Forex trading. It encompasses developing clear strategies for managing capital, such as identifying your maximum risk per trade and employing stop-loss orders to restrict potential losses. Diversifying your trading portfolio across multiple currency pairs can also reduce risk exposure. Furthermore, cultivating a balanced emotional perspective is vital. Avoiding impulsive choices and adhering to your trading plan ensures consistent performance over time. Final thoughts. Get ready to dive in. Engaging in Forex trading is an exhilarating journey filled with numerous opportunities and challenges. Whether you analyze charts for technical patterns or anticipate market shifts through fundamental analysis, Forex presents endless possibilities for those eager to learn and adapt. Equipped with a solid strategy, a robust grasp of market dynamics, and disciplined risk management practices, you can confidently navigate the intricate world of Forex trading. Are you prepared to embark on your Forex adventure? Remember, continuous learning and practice are your most effective allies. So, are you ready for the challenge? Hit that like button and join us as we explore the vast and exciting universe of Forex trading, where each trade presents a fresh opportunity to enhance your skills and financial knowledge.